Hi everyone, this is Rob Roy of Elliott Wave Options, and welcome to the ProfitSource software demo. We get tons of questions about how to set up ProfitSource, the settings that I use that are slightly different than what comes standard. So we thought we'd just, instead of trying to respond to everybody via email, etc., we just do this quick live session and go through and illustrate it, and that usually works a little bit better. This is being recorded, so if you miss anything, don't worry about it. We've got broken down to roughly 5 sections that we're going to go through, and we'll do this a little bit differently than we normally do the events where I take questions at the end. We're going to do a little Q&A at the end of each section that I go through, so if you have specific questions during what we've just covered, please ask those there. All right, so let's go into the pre-computed. So for our subscribers, when they go over here, all they have to do is come down here to the open pre-computed scans, and everything's done for you. So you're right here in the Elliott Wave Options. If you're an Elliott Wave Options subscriber, all of that stuff is input there, and you don't have to even run the search. It's already pre-run every single day. So you just click there, and it brings up, here's the list of stocks that follow all of the rules from those confirming indicators. We currently have alerts on FAST and BABA. So let's look at FAST, and so you can see it comes up with all of the indicators on it. So everything is that's programmed in there. So then what I'll do is I'll come through and I'll turn all this stuff off, because I already know that it's the settings that I'm looking for, it qualifies, or it wouldn't have gotten a result. And let's just go back and let's just go back and look at that real quick. So out of the entire universe of optionable stocks, we now have 9. So we've whittled it all the way down to 9 that follow the confirming indicators. We haven't even put Elliott Wave on there yet. Notice Elliott Wave's not on the screen yet. We haven't even done that yet. But just from the set of confirming indicators that are utilized, there's 9 to look at. Now we apply Elliott Wave, and obviously we will whittle it down further from that. So when we look at FAST, and this is actually an interesting one, I don't want to get too much into theory. I want to stay focused on the tools, but in looking at this one, follow the highest degree is something that's always within Elliott Wave degrees. Quite often we're talking about the patterns within a pattern, but it also works the other way. And you look at this, and in Elliott's viewpoint, even though that is a wave 4 by technical rules, because the 23.6% fib level has been hit, it didn't make it to 38.2, and Elliott preferred when it came down to at least 38.2 on the wave 4. So he talked about how he would consider looking at that as potentially one big impulse with just a 23.6% correction. And that's where we go and we take a look at the weekly chart and see what's going on. And look at that. You can see on the weekly chart, it's in a wave 3. So now it makes sense, doesn't it? I mean, you can see what Elliott's talking about. Look at that wave 3. There's obviously no corrective move within that wave 3 at all from that low point that occurred where this most recent wave 5 pattern started. So that's just where we get into the pure Elliott Wave stuff. So we hit the target today. You can see it tried to trade above it, and it closed right on it. We'll watch and see if we want to take profits soon in this or let it go for a while. It's at a 64% extension, so it's pretty close to the 61.8. So we've got a little bit of fib resistance here, the tap box target, etc. And then when you start to think about it, then we'll look at the DMI and say, okay, is the strongest part of the move over, or do we still have more to go? And when you look at the DMI, it's telling you that you're kind of likely to get an extended wave 5 here. In other words, the 5 to go up to 100%. Because look at the separation with the 2 directional indicators and the ADX. Again, all the stuff that we went through in the trade scam course, talking about all these kinds of things. So the ADX is still moving up. There's good separation there. But I wanted to show you that it's that simple. And then there's been a lot of commentary on the consolidating stocks. Here's something really cool that you can do within these. And I wanted to show you, actually an alert that just went out today, so you should have seen it. On the consolidating stocks, you can see there's 232 of them. Well, the consolidating stock has the least number of variables of any of the searches by far. Basically, what I'm looking for in general terms within volume and a few other things is a very low ADX. When the ADX, because the ADX is usually telling you when the stock is trending. That's when the ADX is going up. When the ADX is going down or very quiet, it's trendless, which is what you're looking for in a consolidating stock. This is when we're looking for triangles. So this is when the triangle tool comes into play. But you're going to look at that and say, well, the whole idea here, I thought with the searches was to whittle out a lot. Well, we still are. We still whittle down. And it takes forever to go through charts and look for triangle patterns. But there's another aspect of doing it where you can utilize it to find triangles in wave 4. Triangles show up, and this is just Elliott Wave rules, triangles show up often in wave 4. So if you wanted to, you could change this search and run the consolidating stock search on the wave 4 list. Take a look at this. There you go. So how many results did we get there? From 232 and 118 to 17. So there you go. Here's an alert that we just sent out today on NIO, which by the way is like the China version of Tesla. Certainly a long way to go to reach that, but it's an electric car company in China. And so when we send out alerts, they look like this. You should have seen these, but if you haven't, this is what it looks like. And there's a chart that's included in there, and there's that really cool triangle tool. So you can see the triangle tool, and then there's the break that moves up to the target price. But look how cool that is. My point here is that you don't have to just look at these for triangles without the Elliott Wave pattern on them. Elliott said that the corrective pattern takes precedence, so the triangle takes precedent. So when you're looking for triangles, you can turn the Elliott Wave off if you want and just look for triangles. But there's another aspect of doing it where you can utilize it to find triangles in wave 4. Triangles show up, and this is just Elliott Wave rules, triangles show up often in wave 4, exactly like that example that we just sent out. So if you wanted to, you could change this search and run the consolidating stock search on the wave 4 list. Now that's only one aspect of using the triangle, because remember, triangles can appear in any wave. And then this corrective stocks, and I'll highlight this one too, we just talked about that last week, is the fact that in the corrective stocks, you could have a wave 5 that's correcting in a bigger zigzag that's going to continue to the upside, or you could have a wave 5 that's correcting back towards the previous 4. Look at this pattern. We're getting off the mark again, but it does kind of tie in. But see here, see this zigzag in the wave 3? And then that was a complex A wave of a larger zigzag, and both of those are within the overall 5-wave pattern. So going back to the comment of, aren't I changing Elliott Wave rules? No, this is Elliott Wave. This is what makes it so cool. And this is what really bothers me, because people don't teach this. This is the cool part of it. It's so much more than looking at those little circles on your screen, and that's, people get caught up in that, and that's all they look at, and they don't learn all the really cool things and the intricacies that Elliott Wave can do. But this is it. This is the stuff. I mean, you've got that. Look at that. You've got a pattern, beautiful pattern right there. 161% extension, dead to the fib level, and then it corrected back to the previous level. And that's all part of a bigger zigzag, all part of a 5-wave Elliott Wave pattern. Degrees, breaking it down. All of that could be traded. You don't have to sit here and wait for this wave 4 to form and just trade that 5. You're missing out on so much by doing that. All right, so soapbox over. All right, so let's look at some of the tools. The zigzag tool. This was something that we talked to the hub guys about, and looking at the ABCs. Then with the ABCs on the charts, then you got to go to the fib retracement tool, and you draw the fib retracements. Then you got to get to the fib extension tool and draw the fib extension tool, and you got lines all over the freaking place. And so we talked about this, and so they created this zigzag tool. And so all you have to do is just look at it, an impulse and a corrective move, and then use the tool and let it do all the work for you. So there's the end of the impulse, and then where's the corrective move? All right, 43%. So that's right at the 38% level, right? And if it was off the closing price, and there's a lot of debate about closing price or high lows. Quite often the fib levels get touched, but I know there's a question, Kev asked the question. It doesn't have to be quite that exact as far as whether or not you're doing the close or the high low. But you can see where we had this 100% extension here, tried to trade above it. It couldn't do it, but the target was there. So the 100% extension was the target for an extended wave C, because the 38.2% B correction, the initial target is 61.8. So you see we opened here and we traded below it, and then the next day traded right back above it, came up, came back and tested it, which it does all the time, and then moved up, tested it again, and then we went to the 100% level. So all of that was exactly what goes on within Elliott Wave. But once you got this confirmation close here on the 9th of April, the likelihood was you were going to the extended target. So that would have given you a little bit of comfort because the next day we came down and tested the level, but you'd had the follow through day. So you trust that you're in an extended pattern and you're going to go to that 100%. So that finished that. And then we came back down and went to the previous fib level. So then you look and it's pretty clear, I think, that starts a new impulse move. You can see the gaps, which I don't like the gaps, but it's pretty clear that we had this low. We tested the 61.8% and we started again. So again, just click on the zigzag extension, start there, bottom to top. How far did we correct? 50%, 52.9, around it is the 50% level. Look what happened when we hit the 61.8% fib level. We had looked at this earlier. Resistance. We came back down, and here we are right at the previous wave 3 high. So we have the previous wave 3 high and the 61.8% level playing ping pong back and forth. So that's fine in resistance, that's fine in support. And as you can see, for what, 2 weeks, the market just went back and forth between those two levels. But that's the zigzag tool, and it's fairly new, but it's really cool as far as drawing things. Now, in drawing tools, there you can see here that they're the newest ones, so they're the last 3. So you can have this without the extensions on it, just the zigzag without the extensions. I like to use it with the extension, but notice that you don't have to. You can draw your own fib extensions if you want. I like, because it just does everything all at once, and it's just 2 clicks, and you're already figuring out where your target's going to be. I'm going to come back to this in a second, but I did see a question on the 45-degree angle. I like 45-degree angles, so I tend to always draw the C wave. Here's my thing with the 45-degree angle. Stocks that move at a 45-degree angle, let's look at one. Stocks that move at a 45-degree angle, this is a great example. It's actually on the search list. We had an alert on this that we exited, and I'm trying to find another entry. You can see it got a bit overbought and it corrected. We got out here. But look at that run right through there. Stocks that do this, that run like that, those are my favorite. When they just run at a 45-degree angle, look at that wave 3. And the reason I say that is you don't get violent corrections. See, we had a little correction here, so we identified that. Intraday, we got out at the top of this bar because intraday I saw that every time the stock went up, there was heavy volume selling into it. So somebody got out of it right there. Obviously, they got out too soon, just like we did, but you have a nice profit, you're happy, you move on. And then it came back down, and then it went up, and it corrected again. There's a doji, and moving back to the upside. It's still really strong. And you look at the DMI is just like, it's just like we're strong. But the 45-degree angle, this is a great example of it because this is what happens. These are your corrections, just these little moves. are the corrective moves in there. Some point we will create a wave for at some point. When you have stocks that go more vertical, when the move is more directly to the upside, then you tend to get more violent corrective moves to the downside. That doesn't mean you have to get out, and it doesn't mean the pattern's changing, but now you have to absorb that downward move, and then you wait for it to turn around, and that's where the patience comes in of the pattern coming back, and you can see that's kind of a zigzag there. But when you have the 45-degree angle, they hold their patterns. You just don't get the violent corrective moves. Corrections are more shallow. They don't hurt you. You can hurt as much. You can stay in. They don't affect the trade as much, etc. So hopefully that helped explain it. But that's why I like the 45-degree angle. All right, so the next tool I wanted to show is the triangle tool. The one that we sent out today. The good illustration of it, because you can see pretty clearly the triangle formation there. If you want to get a little bit more specific in that and picking your points, then you can go through and you just pick the highs, and it draws the in-between points for you. So you're getting more of an Elliott wave structure to your triangle by using this tool rather than, I can just use, and this is what I used to do before we had this tool, is just, draw the lines with a line segment tool, connect highs and lows, and it's still functional. It's not as technical, though, as utilizing the triangle tool that gives you the pattern within the triangle, and then you can see the breakout that occurred there, and then there's the Elliott wave pattern with the potential price target. So you can see, this is, again, getting off the subject, but important when it comes to this stock here is this $10 level is really important in the world of trading, because by prospectus, if you're talking about mutual funds or investment accounts or whatever, you have to be very aggressive to, your objective has to be very aggressive to trade stocks that are under $5 a share, because those are penny stocks. So almost no mutual funds or anything can. So see, as it broke above 5, see how it got more interested, see how the stock was just doing nothing, and then it was able to break above 5. Well, now more mutual funds and institutions are allowed to trade it because they're listed as aggressive on their prospectus. Well, if you get above 10, now you can get the growth funds in there. They don't have to be just aggressive, just growth. Not growth in income, I don't think this is another threshold, but just growth minded can trade when it gets above 10. So boom, another gap where you get another big chunk of investment that comes into it, because you've opened up a whole nother category of investment accounts that can take advantage of it. And so that's why you see the weird looking picture where it just hovers around nothing forever, gains momentum when it breaks above 5, gains even more momentum when it breaks above 10. So here's what I was talking about as far as that. See how it went vertical, and what do you have to do? I mean, vertical, now you got to come back and wait for that corrective move, come back down. So 45 degrees don't do that. The vertical moves do. But that covers the things that I wanted to share with you on the tools. But I know I spent a lot of time on the zigzag tool, but the triangle one is one that I wanted to make sure that I highlighted as well for all the people that are saying, I just don't see the triangles. Well, now you don't have to, and it'll draw them for you. It's pretty cool. All right, so with that said, one of the first things that I wanted to cover is this right here. This little bar here that says Elliott Wave and 1597. So that's the count. You can right click on the Elliott Wave properties, and you can see here it's data points, or data points as the Aussies say. And basically what that tells you is how far back the algorithm goes to start the Elliott Wave count. Kind of similar to how a moving average works. I had conversations with the hub guys, and here's my thinking. And is that an extreme number? Absolutely. The default's 300. You're probably aware of that. And a lot of people ask, why does yours say 1597 up there? Well, I changed it. again, you right click there, click on the Elliott Wave properties box, and the data points is how you change it right there. Notice I don't have any of the EBOTs on. I turned off the ABCs, which we'll go through and talk a little bit more about that when we get into the individual new tools that are associated with ProfitSource. And I keep the screen pretty much as clean as possible, except for the 1, 2, 3, 4, and 5, because I prefer to use these other tools to draw those connections. So we'll get to that, as I said, in a little bit. But why did I change that from 300 to 1597? Well, first of all, that's a weird number, isn't it? 1597. How did I come up with that? Well, it's in the Fibonacci series. So as you continue to go up in the summation series, you will eventually get to the number 1597. Remember, the summation series is where you add the previous two numbers and it gives you the next. So we will eventually get up to that level. And the reason for 1597 is Elliott Wave by design, Elliott Wave analysis by design is analyzing supply and demand based on fear and greed. It's a mathematical formula that uses a whole bunch of calculations of that basic theory of the market moves by supply and demand based on human fear and greed to create the Elliott Wave count. So my thought process was, if what Elliott Wave is designed to do is analyze data, well, let's give it more data to analyze. Just simple as that. But a long-winded story is, I would notice from time to time the relabeling would occur, and there didn't seem to be any significant change in what was going on. So by moving the data points further back, it was my experience that filtered that out. And I want to stress that it's not very often. It was rare that this occurred, but remember, I'm doing all kinds of scenarios and running test searches, and so it's small. It's a very rare occurrence, but my thinking is, let's be as accurate as we can be. All right, so
Hi, Rob. David has a question in the chat just regarding the EBOTs and why you have them turned off.
Okay. Let's go back and put them and show here. There's the EBOTs. Now, EBOT stands for Elliott Breakout Trigger. And so if you turn these on, you just check the boxes for 3, 4, and 5. And there's the lines that coincide with the various 3, 4, and 5 Elliott breakout triggers. And so it's designed as another indicator to help confirm the movement. The reason that I turn them off is I'm already going to use, as you can see, now we're starting to get some stuff on the screen, right? I do like clean charts, and so many people comment on how clean the charts look within Integrated Investor and ProfitSource, and I really like that. So I haven't followed the EBOTs that closely. I much prefer to look at what's going on with the flat zigzags and triangles, the corrective patterns within them. And we're already using our set of technical indicators as an additional confirmation. So I just didn't feel the need to use them and have other stuff on the screen that drew my eyes away. It's not that I don't think that they're accurate or don't think that they work. It is just more aesthetics than anything else, honestly. So if you wanted to have them on, all you do is check those boxes and if they're not on already, just hit the defaults button, save the current settings as default, and then the EBOTs will be on there. So it's really just as simple as that. So the question is, what does TAP mean? TAPP stands for time and price projection. And it's not on right here because we already have a confirmed wave 5. But I'm sure we'll see a chart that has it. It's the box that's up there, and it's pretty cool. Let's see if this is still showing. Watch this. I don't know if you knew you had futures data in here as well, but here's the dollar. I've been tweeting about this and talking about the dollar earlier. There's your tap box. Check that out. So the dollar came down and hit that 5. I hit it just dead in the middle. So this is the price projection area. And time is something we talk about a lot. And I've gone on record numerous times of saying that I'm far more focused on Elliott Wave for price than time. And it's just because I haven't found time to be accurate enough to really just hone in on the date. I'm sure other people, in fact, I know other people really do focus on the time aspect of Elliott Wave. It's just something that I lack as far as being that accurate with it. But I like to use it as a guideline. And this tap box, you can see, gives you a date on the side here. So that's the outside date as far as when this expected move is going to occur. So here's the US dollar. So if you're trading currencies, you had the dollar, and then we're going to talk about this too, but you had this triangle here, really cool triangle in the dollar. We broke out of the triangle, which is what we're supposed to do, bounced up to the wave 4 and came down and hit the wave 5 target, just smack dead in the middle of the tap box. So that is something to pay attention to as far as the forecast of where that's going to go. And then watch what happened is we actually came all the way down to the 100% extension. You can see that the bottom of the tap box was right at the 100% extension. And then we bounced on the dollar. Let's move on. The next one is on moving averages. And so we'll put the moving averages on. The three that I have primarily, and there actually is a fourth one that I look at, but I'll tell you why in a second, that these three are on this button because it's the exponential button. 10, 30, and 50. I kind of briefly mentioned this earlier when we were talking about why that counts 1597. The difference between a simple and an exponential moving average is an exponential moving average weights the most current data heavier than what's further back. So if you have a 50-day moving average, what happened 50 days ago doesn't count the same as what happened today in the calculation of the moving average. What's happened recently is weighted higher when it creates the line for the moving average. A simple moving average weighs every day the same. So 50 days ago and today, they count the same. It's just take the data, average it together, boom, that's it. So that's a simple moving average, but the exponential one, again, weights what occurred most recently heavier. So it's more important. So I like the exponential moving average. I think they're more accurate. The lime green line is the 10-day moving average. Most people view the 10-day moving average as the short-term trend indicator. That gives you the idea of where the trend is going, currently over the short term. You've probably heard me say this. If you hear any of my webinars or recordings or anything moving forward, you'll hear it again. No security in any time frame gets very far away from its 10-day moving average. It just doesn't. So we utilize that for giving us overbought and oversold signals. Very helpful in showing us when something is overbought short term or oversold short term. Then the 30-day moving average is a fairly common one, but usually in conjunction with a 10-30 crossover. A lot of people like to look at when the 10-day moving average crosses over the 30-day and use that as a momentum signal. So there was where the 10 crossed above the 30, and then you can see the market went off to the races since then. Over here, you can see where the 10 crossed below the 30, and boom, we had the big move to the downside in the market. So that's one of our confirming indicators. That's in the conglomeration of confirming indicators that goes into the search, is the 10-30 moving average and the crossover. Where is the 10-30? Where is the 10-day associated with the 30-day? It's in there. It's in the search parameters. And then the 50-day moving average is just, that one's a little bit more for longer term trends. Obviously, it's softer. It doesn't have as much volatility. It doesn't move as fast as the market. It's a more smoothing effect, and it acts a lot as support. As you can see, boom, back to the 50, back to the 50, back to the 50. You can see all these times when we've come here and tested the 50-day moving average. So that gives you what's occurring with those different touches of the 50-day moving average. Now over on the simple moving average, there's the 200-day moving average. And I use that one. You might be like, well, why are the other three exponential and the 200-day simple? Well, the simple moving average is institutionally based. That's what the longer term, the buy and hold people that buy stocks and hold them for a long period of time, the 200-day moving average becomes very important to them. If the stock breaks below the 200-day moving average, at that point in time, they look to get out. And remember, they're in this they're not looking for trading. They're investing. They're in for long periods of time, holding securities for long periods of time. So if it breaks above it, then it can be an entry signal. I'm sure they do other things other than just look at the 200-day moving average, but it is something that institutions look at. And if you see something breaking the 200-day moving average and you're looking to put a bullish trade on, that's where it's like, okay, maybe you want to hold off on that. If you're thinking, oh, we're just going through a correction, this is a good entry, but that correction is breaking the 200-day moving average, probably not a good time to enter. So that one's simple because that's what the institutions use. The other ones we're looking for more trend confirmation, and so that's why I look at those. And the 10-day with the lime green, I think you'd agree when you can make them whatever color you want. Maybe that bothers your eyes, that bright neon greenish color, but it draws your eyes to it, so I immediately see it, especially against the black bars. We've been going through talking about the different settings, the indicators that I've mentioned a bit. We looked at the DMI with whether or not it's going to be setting itself up on the S&P. We just talked about moving averages. We did a trade scan course. If you were in the trade scan course, then you got a chance to see how the indicators are broken down. Each individual indicator, we spent a session on each individual one. So you don't get just how to put them on the screen, what they are, but a detailed analysis of each and every one of the confirming indicators that goes into the search criteria that create that search system of confirming indicators. Our subscribers get all of our education for free. We have all the stuff listed on a website. We have an education tab. You can go in there. You can pick and choose various parts that you would like to learn more about. The trade scan course is in there. As I said, our subscribers get all that stuff for free. So if you'd be interested in learning more about how these indicators work and work together, and I think when you're talking about multiple indicators, it's important to make sure that you have indicators that gel together. There's a ton of them, right? You come over here, look just under the indicator tab. Look at all those. I went through and I fooled around with every one of them because, people did Williams percentage R. People look at that. I couldn't generate a lot of success with it myself, but people look at it, they talk about it. People look at RSI, et cetera. People look at all these different indicators. So at some point in time, you can't have every single indicator on your screen. You have to, or you just talk about not being able to see anything. And you're never going to get all those indicators to agree, are you? I mean, you don't get to where all the indicators are telling you the same thing. So what I try to do with these indicators is create a grouping of indicators that complement each other. So they work in a similar fashion, and one indicator may have this as a weakness, but this other indicator, that weakness is this indicator's strength. So, where one may be lacking in something, we have a different indicator to take up for that. And I think that makes sense when you think about it, is you want indicators that are congruent, that work well together and complement each other. So it's not as easy as just throwing a bunch of them. I thought it would be, but that's what I found out by spending all that time going through and testing all these, is that it's not. You have to have, in creating a system, a grouping of indicators that work well, or you never get any results. They cancel each other out, and you can't, because it'd be easy just to say, I just want them all, right? And just go through and list them all. I want all the stocks that give me a green line on all those indicators. Well, you're never going to trade, because they don't. They don't all line up like that. It doesn't work
Rob.
that way. Yeah.
There's just one final question on the moving averages from Kathy in relation to why you don't use Fibonacci numbers in the moving averages.
Good question, Kathy. I have utilized those Fibonacci numbers in the past. It's a great question, and I have changed a number of settings to reflect Fibonacci numbers. Like if you look at the DMI, you can see that I changed it to 13. It's 13 and 21. A lot of things have, or a lot of software programs use 14 and 20 for their settings. So in that aspect, I did change some. As far as looking at them in moving averages, I I've looked at them. I started to do some things with crossovers. Didn't necessarily see them being more accurate than the 1030. And you know how we talk about sometimes things become self-fulfilling. There's no doubt that, and whether or not we covered this in the Fibonacci section of our Elliott Wave course that we're doing now, is whether or not you believe there's a mathematical order to the universe or not, there's a lot of software programs that have their support resistance levels programmed based on Fibonacci numbers. So the thing is, if enough people are looking at it, then we need to know where they are. Again, you don't have to necessarily believe there's any magic to them, but you should know where they are, because it's likely that they're going to act as support and resistance because there's enough things programmed to it. I happen to actually believe that there's more to it than that, but that's just my opinion. Everybody has their own opinion. But that's a fantastic question as far as looking at the moving averages based on Fibonacci numbers. I can honestly tell you, I haven't gone through and looked at every pair. I did look at 8 and 21 instead of 1030 was one of the ones that I looked at, and it might have just been a little bit too quick. I looked at 13 and 34 was a combination that I looked at as well, because that's pretty close to 1030, and it wasn't that much different in the long run. But what a great question.